All right. Good morning, everybody. We're going to give it just a second. Zoom takes a second to allow all of our participants to roll in. So we will give it just a few minutes. Well, not a few minutes. That would be crazy, but just a couple of seconds. All right. Hopefully everybody can see my screen okay. Welcome to today's Wyoming Community Navigator Program webinar. This is year-end tax planning. So we have the wonderful Derek Campbell with us today. Just to give you a little bit of information, my name is Mandy Bailey. I am the advising and education director for the Wyoming Community Program, and I will be your facilitator today as well. I'll be running the show behind the scenes, and so hopefully we do not have any technical difficulties. Just to give you a little bit of information, today we're going to be covering some year-end tax planning. Derek's going to give us some tips, some updates, and then we're going to have time for questions at the end. So if you do have questions, make sure that you either post it in the Q&A or in the chat, and we will get to them towards the end of our webinar today. So the Wyoming Community Program is funded through the U.S. Small Business Administration, and it utilizes Wyoming Entrepreneurial Support Network to reduce barriers that all small businesses often face, including those owned by women, veterans, and those from rural communities and communities of color. We use a hub and spoke model to pursue our goals. Through our collective efforts, we provide access to capital, as well as some technical assistance and program advising. So just to give you a small tidbit of information about the Wyoming SBDC, Devin Costa-Cargill will give us a little bit more information.
Good morning, everyone. My name is Devin Costa-Cargill, and today would like to just give you a brief overview of what the Wyoming SBDC network offers to the state of Wyoming small businesses. The Wyoming SBDC network is a University of Wyoming program, and it's available to all residents in the state. Our program is funded by collaboration through the Wyoming Business Council and the U.S. Small Business Administration, or SBA. And of course, our host is UW. We provide no-cost confidential advising and technical assistance to all Wyoming entrepreneurs and small business owners. And our advisors are located throughout the entire state. I'm specifically located in the Northwest, but we not only help small businesses get started or entrepreneurs with those pre-planning ventures, but we also help current owners with their growth, their retention, and their exiting strategies, and recovering from challenges and hurdles that they may face. So we're really there for the long haul. Each advisor has a unique set of skills and professional experiences. So each of us serves our regions really well, but we also serve the entire state. Specifically, my passions tend to lean towards strategic management, efficiency, human resources, and team building. And I'll put my contact information in the chat for you. Thank you.
Perfect. Thank you, Devin. And without further ado, we are going to get to our presenter, Derek Campbell. And I apologize for looking off to the side. I have two screens. So Derek is the co-founder of High Point CPAs. He's located in Laramie, Wyoming, and he's dedicated to blending innovative technology with robust accounting practices. Derek's passion lies in client accounting, and we are so thankful that it does, because we need people like you, Derek, to help us all out. And he's driven by the fulfillment of aiding businesses in their growth and their success. So Derek has keen insight into complexities of business and finding satisfaction and contributing to our clients' success. So without further ado, I'm going to turn it over to you, Derek.
Perfect. Thanks, Mandy. Good morning, everybody. Thanks for having me. I think we'll just get right in. I have some good information for everybody today, and then I'd like to have time for questions at the end. So the first tip I have is the importance of bank reconciliations. So I just want to talk about bank reconciliations. It might sound tedious, but believe me, it's the cornerstone of your financial accuracy. Just last month, I was working with a client, and they had been a bit lax with reconciling their accounts. So during the tax preparation process, we found expenses that were never recorded and income that had actually been double counted. So this oversight nearly, if we hadn't caught it, would have cost them thousands in tax liability just due to the missed deductions. So regular reconciliation just means matching every transaction in your bank account or credit card account to the statements in your own records. Okay. And then it's catching little discrepancies that will then turn into big headaches later. So keeping up with the monthly, so you get monthly bank statements from your bank, your financial institution, reconciling your books, like your QuickBooks, to those bank statements on a monthly basis means that we don't have to fix headaches later on down the road or even during tax season. Remember, your financial records are more than numbers. They're the story of your business's journey. All right, Mandy, next slide. Perfect. All right, the next thing I always like to talk about is balance sheet accuracy. So hopefully, as many of you know, your balance sheet is the backbone of your business's financial structure. Accurate assets and liability recording is not just good practice, it's essential for understanding your business's true financial position. I personally always tell my small business clients to review their balance sheet for accuracy. When I'm working with a small business owner, we're not necessarily running fancy financial ratios in order to get value out of the balance sheet. Instead, we use this tool as a good overview of the financial health to see where our assets are, where our liabilities are. But also importantly, we use it as a tool to see if things are accurate. So if we review your balance sheet from top to bottom and we can see that, you know, your loan balances look reasonable, your bank accounts seem to match, or your bank balances seem to match what's reported by the bank, then we can assume general good health of the rest of the financials and proceed with making accurate decisions based on them. From a tax perspective, regular reviews of your balance sheet helps to identify and prevent mistakes, which then ensures that you can plan for tax liabilities and feel confident that your tax filings are ultimately correct when they're filed with the IRS. All right, the next piece is the profit and loss statement review. You'll flip forward, there we go. All right, so moving on to profit and loss statement, you'd be surprised how often businesses, even well-established businesses, get tripped up here. One time I was working with a client who'd accidentally recorded large personal expenses as a business cost. So it inflated their expenses and distorted their overall financial picture. Many of my clients, when they're looking at their profit and loss, they're thinking only tax, not necessarily business. So when they saw that they didn't have a lot of profits, you know, they didn't plan for taxes accordingly. Luckily, we caught it during a routine review, but it is crucial to regularly check that your revenues, costs, and expenses are categorized correctly. Reminder that your P&L is not just for tax purposes. It's a tool for making informed business decisions. And then keeping a close eye on gross and net profit margins can help you identify areas of your business that are not doing well. Ultimately, from a tax standpoint, the profit and loss is what we use to calculate your tax liability. So as you're reviewing your profit and loss report, this is what's going to give you an indication of we're probably going to anticipate owing taxes if we're showing a large bottom line number. If we're not showing a large bottom line number, does that match what our experience of the business is, or do we have something that's incorrectly recorded, and do we need to take a second look? Okay, don't wait until tax time to review your profit and loss. Please review your profit and loss reports on a regular basis, but this is obviously ultimately what we pay taxes on, so it is the most important piece of the tax planning process. All right, moving on, let's make sure we get all of our expenses captured. So as you know, little expenses can add up, and missing them is like leaving money on the table. This one was several years ago. I'd worked with a client who ran a small bakery, and they were in the habit of using their personal credit card for small purchases as they went along throughout the year. And since they were small enough, it was a husband and wife ownership situation. The wife did most of the accounting work on the back end, and the husband did most of the day-to-day operations of the bakery. He would use his personal credit card for small purchases throughout the year, and then would fail to provide the receipts to his wife, who was doing the record keeping, because they felt incidental and small. Well, in the grand scheme of things, as we looked at the end of the year, those had added up to over $1,000 in missed deductions because he hadn't accounted for them correctly. So it's always really important to keep an eye on your personal accounts for any business-related transactions. we'll talk about in the next slide about separating personal and business transactions. So we want to make sure we keep them separate, but it does happen occasionally where you use the personal account for a business transaction. That doesn't mean the transaction is not deductible. It's just really important that it's recorded correctly. Some other things here that I like to go over when we're talking about capturing all expenses. The way the IRS words expenses for your business is that they have to be considered ordinary and necessary to operate your business. Okay. And so that's pretty broad, but basically it means if you need to buy supplies for your business, please make sure you're deducting them. Another thing that comes up a lot is business use of home. If you're in a business that doesn't necessarily have a physical location, you're running the general operations of your business out of your home or your home office, it's possible to take a deduction for the use of your home and the costs associated with using your home. And so that's obviously an economic impact to your business and should be reflected on your tax return as well to ultimately reduce your tax liability to the IRS. I also really, and this is one where I also really emphasize the importance of using technology and tools for tracking income and expenses. QuickBooks is by far the market leader in this space, but I understand that it can be expensive for small business owners. There are certain programs that offer discounts with QuickBooks, but there are other softwares that work as well. So find a system or a tool, even if it's an Excel spreadsheet, that works for you to make sure you're capturing all of your expenses, but make it digital. I mean, the paper receipts in a shoebox, it's not effective. It doesn't work well. So find a way that you can keep up with it a little more regularly. Okay. And then moving on, Mandy, along the same breath, separating personal business expenses is just something I cannot stress enough. Keep your business and personal expenses separate. Going back to the same couple that I had worked with who ran their business together, I've already mentioned they had the habit of using their business account for some personal expenses, which we identified the problem for the tax liability side of things, but it also turned into a huge headache when eventually they got audited by the IRS. The IRS really does not make kind of mixing business and personal. We call that commingling of funds. And it really honestly took a good amount of time and effort to sort out that mess. They really need detailed receipts and records to justify every transaction. And the burden of proof just becomes basically what happens is your IRS agent all of a sudden doesn't trust anything that you provide. And you have just this uphill battle to defend every deduction you have once they find out you've been commingling your funds. It's just really not a situation you want to get into. Apart from that, having personal transactions in a business account or vice versa makes your accounting process and your record keeping nearly impossible. So just do yourself a favor, keep your business transactions in your business account, personal transactions in a personal account, and then transfer funds between the two accounts as needed, right? If you need more money in your business account, you can transfer money from your personal there and then spend the money on business expenses. Vice versa, if you have profits in your business that you'd like to take out personally, please do, but transfer them to a personal account first before you spend them on personal items. All right, Mandy. The next thing, business meals. This is one that a lot of my clients get hung up on, and this is one that's also super confusing because the rules have changed back and forth over the last few years. So with some of the tax law changes surrounding COVID, there was an opportunity to deduct 100% of the meal transactions for 2021 and 2022. That has since expired, and 2023 we're back to the 50% deductibility criteria. I'm going to go through the list here because there's a lot of misconceptions around what truly justifies a 50% meal versus 100% meal, things like that. The first thing I really want to hammer home is that entertainment deductions are not deductible. This changed with Tax Cuts and Jobs Act several years ago. So, buying tickets to a Wyoming Cowboy football game, even if you're taking clients or customers, that's not a deductible expense to your business, unfortunately. Okay. 50% deductible, that would be business meals, meals provided in office for meetings with employees, customers, things like that. This could be meals provided at a company cafeteria. I'm sure that doesn't relate to very many of the businesses on the phone call. food items at work, such as coffee, snacks, sodas for employees, those are 50% deductible. Okay. Meals while traveling for work, those are also 50% deductible. Okay. And then if you attend a conference for work or a training for those meals that you pay for there, those are also 50% deductible. All that being said, there is still some leeway in getting 100% meal deduction if you fall into these circumstances. So food for recreational employee events. So this would be like a holiday party or a summer picnic or a team building event. If you're purchasing food for that event, that's 100% deductible. You don't have to take half of that deduction, okay? Food provided to the public to promote goodwill. So maybe this is offering your customers coffee or snacks if they come into your business, things like that. You can take 100% deduction for that. Meals that are an essential part of your business function. So if you're a food blogger or a food critic and you have to obviously go out to eat in order to write the blog or provide the critique, those meals are 100% deductible to you. Meals provided to employees at the convenience of the employer. This is probably the one that's miscategorized most often. So if you're enticing your employees to stay late after work to help finish a project or a presentation, and you purchase a meal for them in order to provide more convenience to you as the employer, that can be 100% deducted. And then lastly, meals sold to a client or customer. So obviously, if you're in the business of preparing meals and selling them to your clients or customers, those meals are 100% deductible. You don't have to take a 50% deduction there. Okay. It's always important to keep up with IRS guidelines. These rules, as we've seen over the last few years, can change on the drop of a pin. So just keep up to date, ask questions if you're unsure. And then as you're going through your accounting and preparing for tax time, really think about which meals fall in which bucket so that you can get the maximum deduction there. Okay. All right, Mandy, let's move on to 1099s. Okay, 1099 compliance. 1099s are obviously the forms we love to hate. They are crucial, however. I commonly call these the IRS's tattletale forms. Basically, what these forms are is you have to do some of the dirty work for the IRS. So if you fall under the requirements, we'll get to these, the requirements of filing a 1099 to a non-corporate service provider that you work with, the IRS will then take the sum of those 1099s and match them up to that person's tax return to make sure that they're reporting enough income and following all the rules, and vice versa. Okay. So if you pay more than $600 to any non-corporate service providers, so that would include LLCs in that bucket as well, you have to issue them what's called a 1099 NEC, non-employee compensation. Okay. I've had several clients who've neglected this because they are kind of a hassle, and they're due in January. So that makes the first month of the year a huge scramble to try to get everything filed correctly. However, the fines and penalties associated with non-compliance here are not worth taking the risk. If you know that you've got somebody you need to file 1099s for, just file them. They don't take as much time as you might think they are, and they're definitely not worth a $50 per month fine for failing to file. Okay. Some other key pieces here: if you pay your contract with a credit card or payment processor, like maybe they offer you the ability to pay their invoice online via credit card, things like that. The credit card company takes care of the 1099 requirement for you. You do not have to file your 1099 in that piece. Okay. New this year is if you have more than 1099s to file in total, you have a requirement of filing them electronically to the IRS. Okay. Used to be that you could fill these out by hand and mail them in to the IRS. That's changed if you have more than 10. Personally, I recommend filing them all electronically anyway. It's much easier and much quicker. And there are a variety of online providers that you can use to help you knock this one out. QuickBooks has their own built-in if you use QuickBooks, or one that I recommend a lot is tax1099.com. The fee is pretty reasonable, and it kind of walks you through the process of putting in the correct information and issuing the 1099 or filing with the IRS. This is also my opportunity to give you a reminder that a completed W-9, Form W-9, needs to be on file for anybody you pay for services. This includes the corporations. That way you have proof that they file their taxes as a corporation and do not require the issuing of 1099. Okay. My rule of thumb on W-9s is if in doubt, just request one. Get a W-9 from pretty much anybody you're paying in your business. It doesn't hurt anything. If you have it on file, it doesn't hurt. they're not required, if you're not required to send them a 1099, you won't send it, but at least you have it on file to prove that you requested the appropriate information. Okay. I don't really want to get too crazy, scary in this slide here, but 1099s are not the only 1099s that are required through this process, or 1099 NECs, excuse me. There are also 1099 miscellaneous forms, such as if you're paying rent to your landlord and your landlord is not a corporate entity, you probably need to issue them a 1099 miscellaneous to report the rents you're paying to them. There's also 1099 interest forms. If you're paying interest to an individual, maybe you have a personal loan through an individual, you need to issue a 1099 interest form. All kinds of 1099 forms that come up here. If you have questions about a payment you're making that may trigger 1099, it's probably best to reach out to a professional and ask that question. Okay. All right, Mandy, let's talk about estimated tax payments. Perfect. Okay, estimated tax payments can be tricky, especially if you're juggling multiple responsibilities. I have many clients that underestimate their tax payments in 1 year or fail to make estimated tax payments throughout the year. The unfortunate side of that is that then when you do file your tax return and pay your tax liability, you have penalties and fines to pay on top of what you owe to the IRS, okay? It's also crucial to keep a detailed record of these payments. So what I find happens far too often, unfortunately, is that these payments are made, let's say it's made in June, and you forget to tell your tax preparer that you made the payment. The payment didn't come out of a business account. And so there's really no way for the tax preparer to know that you made the payment. And so they don't account for it when they do your taxes. You file and pay, you pay more than what you needed to. The IRS will catch it eventually and send you your money back, but it probably will take them several months to do so, and you'll be out a handful of cash in the meantime. So just keep really good records of what you've paid as estimated payments to the IRS. This is also an area where I like to talk about most of the businesses on this webinar today are probably what we call pass-through entities. Okay, so this just means that your business does not incur its own tax liability. This is vast majority of small businesses. And instead, the profits of your business will flow through to your personal tax return and will be taxed at your individual rate, okay? It's a good thing because it eliminates you paying taxes twice, once in a business and then once when you take money out of your business. So it is a good thing ultimately, but it can be confusing to many clients that I work with initially. The reason I bring this up is because of this, if you make your estimated tax payments out of your business account, those tax payments are not a deduction to your business. They are simply you taking the profits of your business and paying your personal tax liability with them, okay? So it's really important that as you're categorizing those payments, it's fine to use your business account to make those estimated tax payments if you wish, but make sure you're not recording them as a tax expense or a tax deduction on your profit and loss report. Instead, the more appropriate way of accounting for that would be to call that an owner's draw, and then inform your tax preparer that you made XYZ tax payments through the year. Okay, that one can get kind of complicated, so it's best to just have that conversation with your tax professional about tax payments, where they were paid from, and just have a detailed record, okay? Okay, Mandy, let's talk about the significance of filing and paying on time. Okay, filing, paying your taxes on time. This one's non-negotiable. Common misconception, an extension to file does not equate to extension to pay your taxes, okay? Many clients get this confused. I've had several clients opt for an extension and chose not to make the extension payment associated, which means that they are subject to a late payment penalty come the time that the return is actually filed, okay? The late payment penalty is a penalty. We don't want to pay any penalties. It's not as significant as the late filing penalty, however, okay? So it's important that we pay our taxes on time by April 15th, okay? But it's also important that we file the tax return. So one thing that I see come up pretty often is, especially for clients that I'm working with on the first time, or they're new business owners, or maybe they're just clients that have had a really rough year and have a hard time keeping up, they get a little bit embarrassed about their lack of plan or their lack of saving, things like that. So instead, they just push taxes to the side and forget about them. Okay. The problem is the failure to file penalties associated with your tax return those are the ones that eat your lunch. Those ones are really significant. They hurt really bad. Always file your return by the deadline. Okay, even if you can't afford to make the payment associated. If you get your return filed, at least it stops that penalty from accruing, and then you can work with the IRS to get a payment plan put in place that will help you get your tax liability paid off. By far the best situation if you find yourself in that place, okay? The other thing that I want to talk about here is we find ourselves in, Mandy and I were having this conversation before the webinar started. We find ourselves in a current climate where it's kind of hard to find a tax preparer at the moment or a tax professional. And so unfortunately, that just means that the current tax professionals are super overwhelmed with the amount of work that they have on their plate, okay? An extension is not a bad thing, and it's probably common that this day and age, you will find yourself going on extension if you're working with a reputable tax preparer, okay? Your tax preparer should work with you prior to the extension to let you know that your return will be extended, and will let you know if they think you should make an extension payment so that we don't avoid paying our taxes late. But there is no evidence that links filing extensions and filing returns in the extension period is linked to a higher audit risk or anything like that. Okay, unfortunately, with fewer tax preparers in the market and with more complex tax code to keep up with, it's just the nature of the industry. And I promise you that your tax preparer is not sitting around doing nothing during tax season. They're doing as much as they possibly can. It's just the nature of the industry at the moment. So I had to put that little plug in there for my other tax professionals in the state. If we could get them all done by the deadline, we would, I promise. And then speaking of professional help, Mandy, the next slide there. Oops, we should be going. There we go. Okay, this is the saying I love to say all the time: know what you know and know what you don't know. In the realm of taxes, this is vital. Seeking professional help isn't a sign of weakness, it's a sign of smart business acumen. I've had clients try to do it all themselves, and oftentimes, even if they're capable of it and smart enough to do it themselves, the stress just becomes overwhelming and affects the performance of their business. When they finally reached out for help, we were able to sort through their taxes, no problem, but it also helps streamline their financial processes. So oftentimes your professionals can help you with more than just taxes. They can offer insights and solutions maybe you're not even aware of. If you're feeling overwhelmed, it's important to reach out. I did mention on the previous slide that the current demand for tax professionals is pretty high. So it's really, really important that you don't wait to find someone to help you, okay? Start the process early. I recommend trying to find someone with a CPA license or an EA license to help you. It's also important that you find a professional that you trust. You know, you're going to be working pretty intimately with this person in regards to your financials, and it's important to work in a high trust environment. Your accountant or your tax professional is going to request a lot of information from you. That's going to be prior year tax returns, copies of probably all of your bank, credit card, loan statements, etc., receipts for major purchases. If there's anything that looks a little out of whack, maybe I see an account that looks like there was a lot of spending, I might ask for more details or an explanation there. Just know that this isn't an attempt to be nosy, it's an attempt to be accurate, right? You want your tax professional to have as much information as possible because it helps us maximize your deductions, it helps us keep you in compliance, and it's also important to note that your preparer is responsible for filing a correct return as well. If I file an incorrect return as a paid preparer with the IRS, I'm also subject to paid preparer penalties. So we're both at risk here. We have to have enough information to file the return correctly, and don't wait. If you need help, don't wait. Start looking now. Possibly you'll have to look outside of your town or your immediate area, but that's okay. Luckily, with technology nowadays, we can work with professionals in other areas. So, all right, Mandy, my closing remarks here. I just want to leave you all with my thought. Good tax planning is about being proactive and not reactive. I've covered many things today, from accurate record keeping to the value of professional advice. It's not just about preparing for tax season, it's about setting your business up for ongoing success. implementing these strategies, staying informed, and please don't hesitate to reach out for help when needed. And so with that, I'm happy to take questions if there are any. And maybe Mandy, you can help me see where the questions would pop up or read them out to me.
Let's see here. We have a few in the chat. Let's see. In reconciling credit card payments that have paid for supplies for multiple projects, should I split the payment also between those projects?
So I'm assuming that means you're probably tracking your books by project. So you must work in an industry that has some sort of project tracking in place. Yes, it's important that you break up your payments to match the project so you get the accurate financial picture of each project. But it's also important that you reconcile the credit card account for the total and make sure that your credit card balance matches your books balance so that you know that even though that payment got split up, it's still accurately recorded on the book.
Okay. If income is variable from year to year and sometimes don't know when a grant will be issued, are we still liable for estimated tax payments?
Unfortunately, you are, yes. The best way to attack that is probably to use what we call the safe harbor method. So when you file your tax return, you can base your current year estimated tax payments based on your prior year tax liability. That's probably the safest thing for you to do. Unfortunately, it can sometimes trigger overpayment. And so if you find yourself making your first 3 estimated tax payments and the business is just not having the revenue that it did, maybe you skip the 4th payment knowing you're probably not going to owe as much as you can. But unfortunately, yes, your estimated tax requirements is based on your prior year tax liability.
And then Derek, can you also repeat the website for the 1099 online free filing?
So it's not free, unfortunately, but the one I use oftentimes is called tax1099.com. It does have a small fee per 1099 that you have to pay, but it's the best experience I've had so far. That being said, if you Google online 1099 filing, there's hundreds of websites and probably a wide array of pricing. You just would want to make sure that they have the IRS e-file logo associated somewhere on that website to make sure it's an authorized provider.
Perfect. And that is all the questions that I'm seeing so far. I know that we're at 11:32, so in the interest of respecting everyone's time, I think that we will wrap it up with that. Make sure to reach out to Derek. Has his information right there. I imagine you're going to be booked solid here soon if you aren't already. And so thank you, Derek, for being with us today. And thank you all for taking the time to be with us as well. With that, I hope everyone has a wonderful Thursday.
Perfect. Thanks, guys. Thanks for having me.
Thanks. Bye.